This is Mark Sobel, U.S. Chair AMFIF. Today I have the great pleasure of being joined by Fabio Nattolucci, Deputy Director of the IMF's Monetary and Capital Markets Department. Fabio has responsibilities for preparing and overseeing the IMF's Global Financial Stability Report. Prior to joining the fund, Fabio was a Senior Associate Director in the Division of Monetary Affairs at the Federal Reserve and also a Deputy Assistant Secretary at the U.S. Treasury for International Financial Stability and Regulation. Fabio, the floor is yours. Thank you for joining us.
Thank you, Mark, for inviting me. It's always a pleasure to chat with you. So what I'm going to do, I'm going to present the main finding of the recently released Global Financial Stability Report. I thought one way to do it before I run through some of the slides, just to give a quick summary, essentially, how we look at the current situation, what kind of framework we have in mind. So clearly, this is a different shock, right? It's not a shock. The 2008, 2007, 8 was a financial shock originated centered in the financial system, in the banking system, propagated beyond banks to other financial institutions, rapidly expanded from the US globally. This is a shock. This is a real shock. It's a pandemic shock originated in one part of the globe, quickly spread to the rest of the globe. But the dynamics of the shock is driven by the pandemic. It's essentially a very different shock. So this is something I think we need to keep in mind. Another difference is also that the response has been unprecedented in terms of both monetary policy as well as fiscal policy, both in scope as well in speed. Thinking about scope, G10 central bank increased their balance sheet by about 7.5 trillion, and emerging markets embarked in asset purchase for the first time, about 150 billion at the time of the GFSR. We have seen more than $12 trillion in fiscal policy stimulus across the globe. And then the speed, again, was very extremely fast. If you think what the Fed did just in the month of March, it took way, way longer than that back 10 years ago. So that's the background. Clearly, policy so far has been sufficient in the sense of they managed to avoid the macroeconomic feedback loop between the real side and the financial side that were so pernicious 10 years ago. So they have been successful. They kept markets open. They managed to address financial market functioning issue. But importantly, they kept the flow of credit going, both in terms of banking sector as well as markets. So that allowed essentially what they originated as liquidity pressure not to turn into insolvencies. Of course, there are side effects or unintended consequences or risk, if you want, vulnerabilities rising. Right? One of that is the focus on the disconnect between the financial sector and the real sector. So financial markets essentially gone too far related to the evolution of the real economy, and then a number of rising vulnerabilities that we had highlighted in previous GFSR that were already elevated coming into the crisis, and then they're continuing to rise. So corporate debt is one risk in the non-bank financial intermediation sector, that what used to be called shadow banking, as well as sovereign debt rising fast. And so the risk, the one we focus, is one where especially if the recovery is delayed, if the pandemic is not brought under control, if the trust in the health response is broken, one where this liquidity pressure may turn into insolvencies. That would have implication for the corporate sector, particularly sector more exposed like SMEs, would have implication for banks that have exposure to this sector, including also exposure by the non-bank financial institution and their interlinkages with corporates as well as sovereign. And so this is the scenario that we have in mind. And so when we propose our policy recommendation, we frame it in terms of intertemporal trade-off between what needs to be done today and what the risks are for the medium term that could put a risk over the medium term. So that's a quick summary. Against that backdrop now, I'm just going to walk you through some of the vulnerabilities, some of the charts here. So this is essentially, the slides is in more concise way what I just said in the past couple of minutes. In terms of one way to assess the policy response is to look at global financial condition indices. We saw a sharp tightening early in the spring, about 1.5, 2 standard deviation, particularly for US, Euro area, other advanced economies. This is only a fraction of what we saw during the GFC, during 2008, 2007, 2008. Also, the window is much shorter, right? So we saw that tightening essentially in a couple of months. Well, it took more than a year back then. And also we see that, again, the successful policy response managed to lean against the tightening of financial condition and ease this financial condition. The only exception here is perhaps China. The driver of the easing of financial condition, that's the chart to your right, for advanced economies is clearly lower rates, those are the blue bar, as well as a rebound in risky assets, in asset valuation. And that's the decline in the red bar. So higher equity prices and tighter corporate bond spread. For emerging markets, the easing of financial condition is driven in part by lower interest rate, although, and I'll come back to this later, emerging markets did not cut rates to zero like advanced economies have done, but clearly have benefited from the improvement in the global risk appetite, and so the global easing of financial condition and the compression in external costs. That allows many of these countries to come back to markets and gain access to global financial market and finance again. In terms of flow of credit, just to put some numbers around the point of maintaining the flow of credit, you can see to the left that starting in April, we have seen the investment grade bond market reopening. Those are the green bar, both for advanced economies and emerging markets. And then progressively, we have seen access also for sub-investment grade borrowers, both in advanced economies and emerging markets. At September, it's estimated here at the time of the closing of the GFSR. But for example, about 1/3 of issuance in terms of hard currency sovereign issuance in emerging market in September was for a sub-investment grade borrower. So clearly markets have reopened even for those. That said, there is still a set of countries, frontier markets particularly, that they have not regained access to capital market. Sub-Saharan Africa is a good example. Last country that issued from Sub-Saharan Africa in February was Ghana, and little action since then. The other side of this is the bank lending. You can see particularly for lending, so the green line, that lending has been very robust, more than any average that you want to take going back to early years. In the US, part of this has been taking down lines of credit. In European countries, has been also government guarantees. The point to make here is that essentially banks have not been part of the problem so far. That's a reflection of the robust financial regulatory agenda and reforms that have been put in place post GFC, and they made banks safer, higher capital, and higher liquidity. And so far, again, they've not been part of the problem. Looking at emerging markets, one way we quantify risk is to look at, we have a bunch of models that look at the probability of capital outflows. So we ran those models back in March. That's the distribution, the black line. You can see there was a 60% probability of outflows. Rerun this now, it's about 20%. So clearly, markets have improved. We've seen top $120 billion outflows from EMs, and we have seen now a recovery of these outflows with inflows in some countries and some asset classes. What is shown to the right is we constructed these new indices. We were trying to assess essentially what was the impact of asset purchase in emerging markets. And I'll say a few words later. But the point was like how to quantify the effectiveness. So one way to do this was to look at whether these asset purchases have been effective in reducing stress in emerging markets. So we build these indices. We look at stress in FX as well as in local currency bond markets. And then we split the sample into countries that had asset purchases, and that's the green line, and countries that did not employ asset purchases. And you can see that with some lagging compared to the Fed announcement, but countries that did employ, in fact, asset purchases managed to ease stress in local currency bonds more than countries that did not adopt asset purchases. And then our trademark summary of this is to look at what we call a growth risk. So essentially, we condition on economic conditions today and financial conditions. We project out expectation for growth, global GDP 12 months ahead. The red distribution shows you what we were projecting back in the spring. Distribution is centered around the World Economic Outlook forecast. So that's the mode. And then financial condition and current condition tell us what the shape of distribution would be based on historical relationships. So this is through the lenses of financial markets, essentially. So you can see back then the distribution was first of all, was very dispersed, right? Well, lots of uncertainty, so very large distribution. And two, that there was significant downside risk. And so at the 5th percentile, so with probability of 5%, there was a probability of 5% that global growth would be 8% or lower. Rerun this for the October GFSR. Now the distribution obviously is centered on the WIO forecast for 2021. And there's a couple of things to note. First one is that the distribution is less dispersed, but importantly, it's very much still skewed to the downside. So there are still significant risks to the downside. The probability of negative growth at the global level now is about 5%. One issue that I raise a possible risk looking forward is this one of the disconnect between financial markets and real economy. You can see to the right that clearly there's been sectors that benefited much more from the pandemic than others. The tech sector is one, so that's the blue line. This is updated through September, so it reflects the correction in September. If I update it now, obviously the top 5 tech stock would be coming back higher. Rebound would have rebounded. The point to make though is that those 5 stocks are the ones that were driving the rebound. The S&P 500 -5, so the S&P 495, if you want, back then was still in negative territory. So more in line with Russell 2000, right? So representing essentially more those sectors that have been hit more by the pandemic. So social, those that were negatively affected by social distancing, and SME sectors. Clearly, SMEs have been hit hard because those are firms that rely more on bank lending, they have less access to capital market, thinner equity cushion, thinner liquidity, and also much more exposed, less diversified revenue, so more exposed to sectors that have been affected by social distancing. Now, what is pushing up equity prices? Right? So we use internal models to try to decompose. You can think of equity prices as the discounted flows of future earnings, right? So what matters is what is your expectation for future earnings, and now you discount these future earnings. So the light blue bars represent the contribution from current projected earnings. So that contribution will be negative, since you'll be pulling down equity prices. At the same time, we are discounting at a lower discount factor, both because the risk-free rate is lower, so that's a green bar, right? This reflects the Fed having slashed their interest rate to 0. And also because risk appetite is back, and so the equity risk premium. So the compensation for holding equity risk that you want to be compensated for, that compensation is shrinking. So that implies essentially that we have lower discount factor. The net effect has been pushing out higher equity prices. Now, one caveat, it's very hard to do this, obviously, because you need to distinguish between intended and unintended consequences. But beyond the specific numbers here, the point to make is that clearly risk asset, and I could show you a similar one for the popular bond market, clearly have benefited from policy support. Another vulnerability is highlighted is corporate debt. You can see that for some countries, France, Canada, US, we are at the upper range of the last 10-year range in terms of corporate debt. Not true for everyone. Some countries that have been hit harder by the pandemic in Europe, like Spain or Italy, for example, we are at the bottom part of the range. But there are clearly underlying credit quality concerns that are rising, right? So you can see default rates going up. If you decompose the aggregate index of default rates for speculative grade into sector, you can see that some tech sectors are clearly driving the deterioration in credit. One quick thing to show here is like there is also an underlying deterioration in credit quality. That's if you look at the earnings to interest expenses, so the interest coverage ratio for the sub-investment grade sector in the US, you can see there is a decline in the ability to cover interest and expenses, but also there's a lot of uncertainty. And that's what the chart in the middle shows, right? So looking at actual and forecast of default rates by credit rating agencies, you can see the range is very wide. Clearly because it boils down to the ability to control the pandemic, how quickly the economy recovers, and whether there is trust in the system or not. And so clearly this huge uncertainty in terms of the economic outlook, it's also reflected in the wide range of expectation for default rates going forward. One thing to quick touch on, it's banks. We did run a global stress test. So we look at about 350 banks in 29 jurisdictions, and we subject these banks to the World Economic Outlook adverse scenarios. And then we look at like, what is the share of banks that under the adverse scenarios would have, considering with and without policy mitigation. And the chart to the left shows you with policy mitigation. What I mean by policy mitigation is, first of all, monetary and policy support, right? That's already embedded in the way of forecast. What we try to highlight here more explicitly is one, credit guarantees by government, and two, bank-specific policy action that affect risk-weighted asset, leverage ratios, for example, as well as loan loss provisioning. And so you can see that there are, for example, in emerging markets, under that adverse scenario, even after accounting for policy mitigation, there's about a third of banks by 2022 that would have CET1 ratio below the regulatory minimum of 4.5%. If you split this by GSIBs and non-GSIBs, as you would expect, the impact is larger for less systemic banks. The next part of the exercise was to come up with a number, a capital shortfall. What would be the capital shortfall relative to some broad regulatory capital with and without policy mitigation? With policy mitigation at the global level, and that's the yellow bar, it's about $220 billion. That can be allocated between advanced economies, emerging markets, GSIBs, and non-GSIBs. The interesting part to me is that if you instead exclude the policy mitigation, that number is almost double. It's about 420. Right? So the point to make is that policy mitigation, in fact, so far have helped maintaining a resilient banking sector and allowing them to continue to provide credit to the economy. Now, as every banking stress test, you could argue that we haven't been severe enough, right? You can always come up with a more severe stress test and come up with bigger numbers. So for transparency here, what we're using essentially is the weird downside. I'm going to skip that chart in the interest of time. Couple of words on the non-bank financial intermediary sectors. We have seen back then huge outflows from fixed income funds, that the blue line to the left. And interesting, we also have seen a coming back of concern in short-term funding markets in the US and globally. So prime money funds saw significant outflows that were accompanied by significant inflow into government-only money market funds. That was an issue that at least some of us thought had been addressed by the reform back 10 years ago. And so perhaps, Mark, we can have that discussion at some point, whether we have learned something that more needs to be done here. An interesting point to me is the chart to the right. So we looked at the actual portfolio of fixed income funds that actually saw outflows. And so the question was whether those outflows and the associated need for portfolio manager to shed assets in a liquid market contributed as an amplifying factor to the volatility in price. And that's what it shows, right? It shows that there is a huge range in terms of bid-ask spread for those bonds that were in fact shed by fixed income assets. That's always been our concern, that this sector could become an amplifier of the shock. Last one is public debt. This shows you the range of public debt to GDP over the last 30 years. You can see that for a number of countries, we are at the upper part of the range, right? Japan, Italy, even the US. And so the fund forecast with the fiscal monitor that by the end of the year, debt to GDP at the global level will be around 100%. Not only that, there are also expectations of wide fiscal deficit going forward, as well as we need to at some point account also for contingent liabilities, right? There's a lot of credit guarantees out there that could materialize or not, and that would have a meaningful impact in terms of this ratio. So I'm going to skip this in the interest of time on the EM asset purchases. I'm happy to come back if there are questions to this later. I want to maybe close with one chart that give you a sense of why we are concerned about all this, how this interconnectedness between these vulnerabilities. So the x-axis shows you corporate vulnerabilities from low to the left to high to the right. Now, every dot here is a country. So we have what we call the systemically important 29 jurisdictions that are subject to FSAP. And then on the y-axis, we have bank vulnerabilities from low to high. And then red dots are those countries where there is medium to high sovereign vulnerability. So there are a number of countries, those are the one in the upper right corner, that at the same time, high corporate vulnerability, high banking vulnerability, and high sovereign vulnerability. And that's the interconnectedness between these three, in some sense, that is a concern. When, if things get worse in the corporate sector, would imply corporate losses for the banking sector and potentially for the sovereign, right? So another way to look at this is the pandemic is going to have real consequences in terms of insolvencies. And so there is only three balance sheets where you can allocate these losses. It's either the borrower, so the corporates, or the lender, so the y-axis, the banks, or ultimately the sovereign. And so, but they're not going to go away. It's just a matter of allocating to the borrower, the lender, or ultimately to the sovereign. And there are a number of countries where these losses could be large and where vulnerabilities are high in all three sectors. That's the source of our concern. And maybe I'll stop here in the interest of time.
Well, thank you for that excellent presentation. There's obviously more to the GFSR than chapter 1, which you focused on. There are some other chapters. So that everybody will rush out and read the GFSR, would you like to give us a very quick summary of what's in the rest of it?
Yeah, so chapter 2 is about policy response in emerging markets, right? And those are unfortunately just, again, in the interest of time, the couple of slides that I skipped there, where we look at the policy response in EMs, not just policy rate cuts, but also for the first time they implemented asset purchases. And so we spent quite a bit of time looking at benefits and costs and possible risks. The chapter 3 focuses on liquidity strains in the corporate sector and what policy measures have been taken. So it's a more retrospective. So it takes the first half of the year, looks at where liquidity pressure, we have seen liquidity pressure, which sector, look at G7 countries, and then try to assess the effectiveness of policy put in place, right? Direct measure, indirect measure, and whether, what kind of firms have been impacted more in terms of those, for example, more financially constrained. Chapter 4 is the bank stress, the global bank stress test that I just discussed. And then lastly, there's a chapter 5 that looks at the environmental performance of firms during COVID-19. And so traditionally, when you have real financial shock, the environmental performance of firms deteriorates. That means that their investment in green investment declines. And so the concern was that that could essentially push us back in terms of improvements that we have seen from an environmental performance over the past few years. Those are the 4 additional thematic chapters.
Great, and we'll come back to some of those themes, I think, in the questions. Central banks have price stability or dual mandates. They conduct monetary policy toward that end. It's said that if there are financial stability concerns, these are best addressed through macroprudential policies. You know, in my past decades, I saw an Asia crisis, LTCM, 9/11, the Great Recession, a taper tantrum. We now have COVID. So financial stability can clearly impact a central bank's ability to achieve its objectives. So should financial stability considerations be accorded more weight in central bank processes and thinking?
So clearly financial stability can affect growth and inflation, right? We have seen now through the COVID-19 crisis, we have seen concern about growth. We have discussion about scarring effect, what would be the impact on the productivity of the global economy, the impact on permanent impact on education, permanent impact on the environmental performance, and also concern about disinflationary forces, particularly in jurisdictions where central banks have not reached the objective for a while. So one way to look at this is also the way we try to assess financial stability risk in the financial stability report is through that distribution of global GDP growth, right? So we look at the left there. So clearly financial stability has implication for growth and inflation, and so directly impact the mandate of central banks. There's been, over the years, central banks have clearly more focused more intensely on financial stability issue. Just to pick an example, there have been publication of financial stability report by a number of central banks, almost everyone now at this point. They're made public. And even just speaking here in the US on the Fed, when the Fed released in August the long-run goals and monetary policy, the statement of longer-run goals and monetary policy, they clearly highlighted financial stability for the first time. They said that achieving in a sustainable way maximum employment and price stability depend on stable financial system. So clearly financial stability risk, it's something that has an impact on the way they look at risk to the achievement of the mandate objective. The question is like, how do you operationalize this, right? So we're talking about events that are by definition low probability event, but with very severe impact. And so how to bring this into the traditional monetary policy setting? One way to think about this is to think about intended consequences versus unintended consequences. And that's how I was trying to frame the presentation here. Or if you want, in terms of the intertemporal trade-off, the policymaker face between action today and what could be the cost in terms of medium term, in terms of putting growth at risk. Now, there are different objectives, so clearly they call for more than one tool, and that's where the discussion about macroprudential tools come, right? So even if you only have an inflation objective, if you had a second objective in terms of financial stability, ideally you would want to have two objectives two tools to hit two objectives. And so that's where the macroprudential tool discussion comes in.
Thank you. And we're not having the pleasure of seeing your smiling face on the camera, but that's a perfect segue into my question, which is, in the US, we have the FSOC. You're familiar with the European Systemic Risk Board. The UK has a Financial Policy Council. The Chinese have a macroprudential assessment process and a huge financial stability division. I mean, do you think that macroprudential policies and the structures for them are sufficiently evolved to manage financial stability concerns?
I think it's hard to make a general point because different jurisdictions are facing different institutional setup and it's different legal setup. And so they have come up with different response to this. Perhaps focusing on the US for a minute, Dodd-Frank created the FSOC. The idea was to have this umbrella over a number of agencies in the US. I think the starting point was we have a very fragmented regulatory landscape in the US, right? So just think about how many different bodies sit at those FSOC meetings. Having participated and presented in some of those. Then there is a second consideration in the US that not all these agencies have directly a financial stability mandate, right? Some of them do not. And so that was the idea, to operate through the umbrella of the FSOC. The problem is how to address some of the issues. So suppose you identify that there is a problem in the corporate debt in the US. How do you address that? Are the power assigned to the FSOC enough to do that? Do we have a framework to think about that? And do we have the tools? To me, those are the three questions, right? Do we have the framework? Do we have the tools? And how do you operationalize it? So one way that FSOC seems to have been trying to address that is to look, instead of designating entities, to move toward an activity-based designation. It's intellectually appealing, but again, the question is like, how do you operationalize this? They still don't have agencies with a financial stability mandate. Still, the FSOC cannot force agencies to take action. And there's also the issue of tools. Do we have the right tools? To me, what we have learned from the March episode on the COVID-19 is clearly more needs to be done. There were the fact that central banks have to step in and backstop, again, an important segment of the financial system. In fact, the Fed created even more liquidity facility than back 10 years ago. That clearly shows that more work needs to be done in terms of both having perhaps a better framework to deal with some of this as well as tools.
Well, I totally share your assessment, and I would say that your answer shows that you are the master of understatement on occasion. But let's explore that. So non-bank financial intermediation under a range of institutions, not the Fed, which does the bank, but others. And you have the FSOC. And some said the non-banks were over-leveraged and that the risks had gravitated there, and that's what caused much of the mayhem. So what do we need to do? Do we need to eliminate the tax preferences accorded debt, according to some, or do we need to be even more aggressive and look at margining, collateral requirements, liquidity management measures such as swing pricing and the like? I mean, what's the view at the IMF?
Okay, so perhaps maybe we want to start quickly what happened in March, right? So we have seen, first of all, that what is supposed to be the most liquid and deepest market, the US Treasury market, froze. When the market is supposed to be the base for pricing risk freezes, creates a problem that reverberates across the world, right? We have seen, again, short-term funding markets coming into huge distress. We have seen, as I showed the charts before, outflows from prime money funds and inflows into government only. That implies that the CP markets are shutting down, muni market froze, the banks' balance sheet were clogged, and so in some cases banks did not operate in making markets, intermediating credit. It quickly translated into the international aspect of this, meaning that US dollar funding markets globally froze, and then the credit markets. So I showed you the chart on fixed income funds. They start seeing large outflows. And that the response by the Fed here was faster than 10 years ago, and in terms of scope, broader. So not only they reset up, they can rate to zero very quickly, they start record high purchase of Treasury security to provide liquidity back and functioning into the Treasury market, but also the reopen the liquidity facility that we experienced 10 years ago and more. Right now, we have facilities for munis, we have facilities for corporate debt, primary and secondary. You have Main Street lending. So clearly, there was a need to jump in and backstop important segment of financial markets and swap lines again back for a number of countries. The risks that we highlight in previous GFSR with reference to the non-bank financial intermediation sector were one, liquidity mismatch, and that clearly played out here as we have seen. There was one about credit, in the sense that in particularly in the advanced economies in the US specifically, non-bank financial institutions are a major source of credit provision. And so this is not just a banking business anymore, it's primarily a non-bank business. So we're talking about insurance company, pension funds, CLOs, private debt funds, and so on. They're also very much interconnected between themselves, as well as still links with banks. And so some of this contingent liability would come up from the back door. And so the banks, it's true the banks are more resilient, more capital, more liquidity, and the fortress is safer, but there are still ways to get back at the banks. And then so all this point to make that the fact that the central banks needed to step in and backstop the system again, only 10 years plus from the crisis, to me shows that we need to really reassess, consider what happened and what have we learned. And so the question is, if every 10 years or so you need a central bank to backstop the system, if you want to live in the world, okay, but that means that the perimeter, the regulatory supervisory perimeter, need to be broader, right? You cannot have a system where the gains are private and the costs are socialized. And so if that's the case, if you want to have access to central bank liquidity, for example, in some form or shape, you need to be within the regulatory perimeter. So to me, there's a need for one, learning what you're learning in terms of where setting the regulatory perimeter. Two, do we have a framework to think about this risk? And I think that that's where way more needs to be done to think about corporate debt, right? Do we have a framework to think about corporate debt, for example? And three, do we have the tools? And I think the answer is we need more tools and better tools to address that. And so that's where I think the FSB work that you mentioned will come in.
Good. Well, I'm looking forward to the holistic study from the FSB that should be out soon, and then I'm also looking even more so as to a concrete follow-up plan with strong recommendations. I'm sure the IMF will be involved in that process. You focused a good bit on emerging markets. They're typically seen as having less policy space than advanced economies. Some are in decent shape, and who would have thought they could have undertaken QE? We would have been worried about exchange rate depreciation and inflation years ago. Many have developed local currency bond markets, but there's heavy foreign presence in those, and they're subject to runs. And then for the less strong, there's a lot of worries about a wave of sovereign debt restructurings coming. So how does the GFSR handle these issues?
Yeah, so that chapter 2 tried to actually focus and assess narrowly the impact and effectiveness of asset purchases, right? So as we said, like, this is the first time they did this. It's about $150 billion for these 18 countries that adopted asset purchases. One thing we learned is that their ability or willingness to cut rates is different than advanced economies, right? So advanced economies went to zero or negative in some jurisdiction. Emerging markets stopped before that. We need to understand better why. Some of the discussion with authorities there and some of the speeches that have been made public by central banks in emerging markets, it's about that the ability that essentially the equilibrium real interest rate is higher than advanced economies. And then there are concerns if you go too low in terms of like pressure on the currencies, possibly inflation, capital outflows, and so on. So I think we need to do more work to understand this differential in terms of where the effective lower bound is for emerging markets. Second point on the asset purchases, there's a great variety in some sense of what has been done and what the objectives were. Some countries purchase sovereign debt, some countries purchase private security, some countries purchase in the secondary market government debt, a few countries purchase in the primary market. Some countries, the size of the intervention was very large. In some cases, the scale was smaller. What we have seen in terms of impact, as you indicated, we have seen that there have been, even after accounting for the easing of financial conditions and the action taken by the Federal Reserve, for example, we have seen they have been impactful in terms of reducing local currency bond yields. So interestingly, as you said, without adversely affecting currency. So without seeing major impact in terms of the evaluation of those currencies or depreciation. And also have been quite effective in reducing stress in the local currency bond market. Now, those are the benefits. Of course, this is new. We will spend more time studying and better understanding the channels through which this work. The question is, if these asset purchases become part of the traditional toolkit at this point, also for emerging markets, the same way has been done for advanced economies, need to think about what are the possible trade-offs, right? Possible costs. One is, particularly in an open-ended format, whether this could adversely affect the credibility of the central bank, for example, the extent to which may be perceived as deficit of fiscal financing on the part of the government in the emerging market, and finally, what is the impact on the debt and liquidity of this market? Those are markets that they are not as deep and not as liquid as the advanced economy. So what is the impact of, if there are significant purchases by emerging market central bank, what is the impact on the functioning and liquidity of these markets as well? Again, this is new for us too, so we did a chapter. We will continue to work on this and learn.
Thank you. Let's let me just throw two more questions at you. The first, China. There's concerns, obviously, about unproductive bank lending to SOEs and excess local government financing. There's concerns about reaching for yield through shadow banking system. There are worries that if the authorities rein in leverage, it will curb growth and forestall the handoff from investment to consumption. Some have suggested that while the central bank can prevent a bank liquidity crisis, the excess leverage in China will further weaken its financial system and further pull down the sustainable growth rate over time, and particularly during this decade, perhaps 3 to 4%. What are your views on this?
So I would start maybe with the pandemic-related facts, right? So if you look at the world economic outlook, China is the only country where we're forecasting growth this year, right, at almost 2%. So clearly, the response in terms of controlling the pandemic and getting the economy back in its feet has been successful. In fact, at some point, the central bank in China even scaled back expectation of further easing. And one of the reasons was because the economy was starting to grow again, but also because they are aware of risk to financial stability, right? So to the authorities' credit. And some of these risks have been highlighted in previous financial stability report, global financial stability report. Just maybe to mention three. One is shadow banking, as you indicated. And so we have seen, in fact, that during the pandemic, wealth management products, so the asset management industry, in fact, has increased borrowing. So leverage has increased financial leverage, and that increase in borrowing has contributed to some of the swing that we have seen in interest rates. The second concern has to do with the capitalization and profitability of banks, right? And that's something that is true for a number of jurisdictions. To the extent that the bank continues to lend and maintain the flow of credit to the economy, depending where the potential losses end up, could impact the profitability. And there were already a number, particularly smaller banks, that we have highlighted in previous GFSR where capital position was relatively weak. The third point has to do, and we have a box in the global financial stability report on this, has to do with the interconnectedness, so the linkages between local governments, corporates, and banks, right? So we have seen local governments that since 2015 have been allowed to directly borrow in markets. And then we see what we call the LGFVs, right? So local government financing vehicles, which used to be used primarily for infrastructure, but increasingly also have been used to provide services and linkages to the SOEs, local SOEs, as well as private sector companies in terms of credit guarantees or equity injection. So the linkages between the local governments, the corporate sector, and the banks themselves who are lending to these corporates, that linkage is between these three at a time when debt is rising quickly and the outlook and they are concerned about credit quality. That's interconnected. It's one vulnerability that we have spent some time thinking about in this report. And there's a box specifically on this.
Well, great. I'll ask a last question. I encourage questions, but I want to keep you gainfully employed at the IMF writing GFSRs, and I want you to have exciting things to write about. So do you think that today's extraordinary policy support is sowing the seeds for the next financial crisis?
Okay, so I think one way to answer that question, perhaps without answering, is to frame this in terms of, again, this intertemporal trade-off, right? So clearly authorities today are doing what is required. This is a severe, unprecedented crisis. It needs to get out of this, we need to control the pandemic. So clearly there needs to be in place health-related measure to save lives and livelihoods. It's important though the pandemic gets under control, not just in terms of measure, social distance, but also in terms of trust in the system. Only after the pandemic is under control, we will really see the economies come back. Now, so we need support today, both monetary and fiscal policy. The question is, what are the intertemporal trade-offs that these choices are making, right? So think about, for example, corporates, right? So you keep central banks kept markets open, allows banks to essentially address this liquidity pressure by borrowing more, but you're adding debt on already elevated debt. And so what are the implications of the medium term? How do you address that elevated debt? How do you make sure that it doesn't become a source of vulnerability for the next shock? Same intertemporal trade-off for the banking sector. So banks have been using buffers. This is positive. They contribute to the solution here as envisioned in the post-global financial crisis framework, right? That these buffers are meant to be used. But at the same time, those buffers, again, once the economy recovers gradually over time, but need to be rebuilt so that the banks are able to absorb if there is another shock going forward. Otherwise, between profitability, weak profitability, and lack of buffer, they could be less resilient next time there's a shock. Similar intertemporal trade-off for the non-bank financial intermediation sector, right? So we need to, today, of course, the Fed intervene, they backstop a bunch of segments in market, but we need to address this issue related to liquidity mismatch. Again, money market's a good example, credit, interconnectedness, to make sure that the risk does not leave the banks, goes to this perimeter, the periphery of the system, where it's more opaque, more difficult to assess, where we have fewer tools and we don't have a framework to think about this. So this, to me, this is the intertemporal trade-off. It's the way to think about it. Central authorities did what's needed to be done, but we need now think about what are the potential risks to financial stability. Are we fueling vulnerabilities that we may come back to haunt us in the future?
Well, thank you. Thank you for having joined us today in your fantastic presentation and having been a good friend to me and Amphif. Grazie, Fabio, meraviglioso, Nathalucci.
Grazie a voi.